Okay, let's kick off. Welcome everyone to this Altana webcast. We're going to be talking about the energy markets and specifically the oil markets. And I'm going to introduce you to Altana portfolio managers who run a fund, a dedicated fund in this space. My name is Dylan Grice, for those of you who don't know me, and I'm going to be hosting this this discussion. I actually am a founder of Calderwood, the co-founder of Calderwood Capital, and we've launched a fund with Altana. So we're very kind of close to the firm, at Calderwood, one of the things we do besides run the fund is that we write research, we sell subscription research, and one of the areas that we've been kind of focused on in the research is the energy sector, is the oil and gas sector in particular. So it's something that we've been very actively interested in. And so the guys asked if I would like to kind of host this conversation with them, and I'm really looking forward to doing that. Before I introduce the guys, Steffen and George, just a little bit of housekeeping. We're going to keep this to 1 hour. Okay, so we will close sharpish at 5 o'clock European time, 4 o'clock London time. Please do ask any questions as when it comes into your mind. Just put it on in the chat. You can put your question there whenever you feel like. And what we'll probably do is leave them to the end. We'll have a proper Q&A session at the end. It's more fun if it's more interactive, so we'll leave hopefully plenty of time for the Q&A. But if there's any particularly pertinent questions, then we'll ask those as they come through. One other thing for those of you who do have questions, if you attach if you give your email address with the question. That will let the guys actually maybe reach out to you directly with an answer if we don't have the time to answer your question during the discussion. Okay, so bear that in mind as well. So good, that's that out of the way. Let's actually hear from your oil gurus, Steffen and George. Steffen, would you like to just quickly kind of introduce yourself?
Yeah, thanks, Dylan. Thanks a lot. So basically, been running. We set up the fund in late 2018, and in many ways, sort of, I came in today's terms from the good side of the energy business, renewables. Did quite a bit in offshore oil and gas, and in offshore wind in the German North Sea. And got an interest for the marine part of the business and quite of industrial contact as well, because the installation processes for offshore wind are done basically a lot by the companies who've done this for decades in the oil and gas industry. So and then with what was happening, and George is going to allude to that in a second, in the oil and gas space, I got interested, and that's of course the value instinct. You saw a lot of money moving into renewables, and the oil and gas side of the business becoming sort of a bit the pariah. I mean, it was only a mild version of what was about to happen over the last 16 months. So, but got interested, and that's how we started the fund. We saw opportunities there. Background outside that is actually in the single family office space. So I always worked for beneficial owners, not in the classic institutional world, and that ties extremely well with what we're doing at Altana, because that's what we do. Is C capital is always the firm and us as management, and so the alignment idea is very key to what we're doing. George, couple of words on you, and then helping us setting the stage a bit.
So basically, I joined Altana with Steffen, where we set up the fund. Previously, I started out with Lehman Brothers, where I was managing European equities, and then with Nemesis Sam in Monaco, also managing European equities with a lot of focus on energy, which is where the interest in the sector came from. I mean, the last 6-7 years have been maybe too exciting for some in the space, but probably the best way to set the scene is to start a bit earlier, back into the 2000s, where the seeds of this cycle were really sown. It was actually an era of perceived resource scarcity due to the accelerating demand growth for oil that we saw by emerging markets. And there was really a palpable pressure back then on oil companies and oil producing nations to increase production quickly. And it was assumed that we have basically found all the easy oil and that we would be getting our marginal oil from more complex projects in deeper waters or from very expensive sources such as the oil sands in Canada, which led to an investment boom across the entire oil complex, which had not been seen since the 80s. And often this has been financed with debt. This bonanza or this party kept on going until 2014, and that's where things started to go a bit off track as OPEC initiated the price war and removed all production quotas. So what had changed in that period? In 2 words, US shale. The emergence of shale in the US really turned the oil industry upside down by essentially creating a new Saudi Arabia. This happened at the worst possible time for the rest of the industry because there had been huge amounts of capital put into new projects and they were all coming on stream in the period post 2014. Suddenly, an industry which was designed to operate in $100 oil environment suddenly had to figure out how to survive at much lower prices. And investment was slashed across the board in order for oil companies to be able to meet their capital commitments, to reduce their debt and to pay their dividends. Eventually, oil prices and activity bottomed in 2016 and 17. We saw the beginnings or the seeds of a recovery in that period, mainly focused on OPEC, or very select parts of OPEC to be precise, and shale in the US. But the scars of the downturn were so deep that the majority of the remainder of the oil space, really, we saw very little investment out there. It was quite a slow healing process, which lasted until late 2019, when we saw an acceleration in investment spending across the broader oil space, only to be hit by, I think, an experience which we've all lived quite violently in the past 12 months, which is the COVID-19 pandemic. And really, this delivered an unprecedented blow to the industry. In 3 months, the world suddenly shut down. The commodity that moves the world suddenly did not have a world to move, and we lost a quarter of oil demand overnight almost. Just to put this into context, we lost around 3-4% of oil demand at the most intense part of the global financial crisis. And pouring fuel to the fire was the fact that Saudi Arabia launched another unilateral price war as OPEC Plus disintegrated, which was quite problematic because the oil industry's infrastructure is not designed to cope with such a quick buildup of inventory. This all climaxed with the famous headline of minus $40 oil, which was mainly a financial phenomenon, to be fair, but it really does serve to illustrate how much stress the industry was under. This violent pricing and demand shock that we saw led to also a violent supply reaction, which was not seen before. A combination of production curtailment by major oil producers in OPEC and outside OPEC, and forced or voluntary oil well shut-ins in the private sector because there were no takers for oil or because the commodity could not be produced profitably anymore, helped balance the market at a lower level than where we were in 2019. But this helped stabilize prices and lead to a recovery and normalization as these excess inventories started to be burned off in the latter part of this year, from the summer of this year. Now we are at the phase where the world is opening up, and with the vaccine rollouts, hopefully we are making a return to some form of normality in economic activity. And our expectation is that we will reach 2019 demand levels later in the end of 2021 or early 2022. And all of this is happening in a context where demand growth will recover and will grow and will meet an oil supply which is quite constrained. And growing this supply might actually be quite challenging. There has been substantial underinvestment in the oil and gas industry outside of shale and OPEC, as I mentioned before, since 2015. And now US shale, which has been the major source of supply growth in the last 10 years, reset its production very violently. And the priorities of the industry now are on a slower growth model. So this means that supply growth really has to come from elsewhere.
Rod, can I kind of just pause there for a minute? I think that's kind of good context, and like the kind of point to emphasize, you basically had two huge shocks, really. You know, the shale gale in 14 that you talked about that really kind of tipped the industry over. It was designed for $100 oil pre-2014, and then it got hit with that surge in shale oil. So the industry was kind of already on its knees, really, by the time the pandemic came. You'd already had kind of, you know, negative capex growth from the majors, you know, from 2015 to 16, 17, 18. There were signs of life maybe in 18, but it was still in the doldrums, and that was pre-pandemic. And can you maybe give us an indication of, can you give us some maybe some numbers on I don't know, the capex or something, just to kind of give everyone an idea of just how kind of traumatic the pandemic, which was the second kind of once in a generation shock in a couple of years, just how traumatic that's been for the entire kind of ecosystem, the entire oil space.
Yeah, I mean, from peak to bottom, even before the pandemic, I mean, capex had dropped around 50%.
50.
And we had some form of recovery, more in activity, but in dollar terms, we probably had recovered around 20%, 30% maybe by 2019, which really saw the acceleration of spending. And then the pandemic hit, and we had another 30 to 40% hit to investment. So basically, since the 2014 peak, the industry has been running at half the capex budget that it was running in the previous decade, let's say.
Right. So okay. I suppose some people would say, well, that's actually that corrects the excesses, because, you know, and it wasn't that long ago, as you said, that people were talking about peak oil, and you know, there wasn't going to be, you know, we were going to have to figure out how to live without hydrocarbons, because they were all gone, and that spawned this kind of massive capex boom. So some people would say, well, okay, so we've unwound that now, right? We've actually and if you look forward, there's just not going to be the same oil demand. It's, you know, oil was kind of like the new coal, right? You know, I mean, look at Tesla's market cap, right? The stock market's telling you that the future is electric, the future is electric vehicles. We just don't really need oil that much. So why do we need, you know, what's wrong with 50% of the, you know, kind of, you know, peak capex? Aren't we now just kind of right sized?
Well, I think it's an excellent question, and there's some truth to it. I mean, we as George mentioned, we came off a huge boom up until 14, and there was overinvestment, and one of the points has been that up until last year, actually 2020, were sort of the last projects that came on stream that were still a function of this investment boom, especially offshore. Is pretty much long cycle barrels. You take an investment decision for a greenfield project, and the first oil is 5 years down the road. So we were working this tail off still of the investment boom. The IOCs stopped spending or dramatically reduced spending 5 years ago, but it didn't show up really in the production profile yet, because they were coming off this tail of big investments. But that's not going to happen over the next 5 years. We've run through this pipeline. So the only area that really created a substantial production growth was US shale. And George mentioned there as well, they are forced into a new model now. I mean, we shouldn't delude ourselves. How this is exactly going to play out, we'll find out. I mean, of course, they're telling everyone right now, oh, we're not going to overspend, never ever again, and all that. We'll see. I think we're quite optimistic. We see how they behave right now. Even when the oil price is increasing, they probably have a rig count by now that has their production stable. But there will be a test going forward, and there's still. I want to see it before I fully believe it. But it's a complete. The problem is that we have outside shale. We're running now out of projects, and we're
wouldn't the argument be? Well, but that's fine. We just don't need the stuff as much as we used to, and each year that passes, we're just going to need even less of it. And so why would what's the problem? Why is it, as I said, hasn't it just been right sized? Energy demand for those barrels just is going to be shrinking kind of permanently from now on.
The energy transition is probably what you're alluding to. So basically we're at or around the level of peak oil demand, and that's a very long discussion. We think it's incredibly unlikely. The key discussion right now is of course in electric vehicles, and basically people say, I mean, the fleet will transition, at least in the developed world, very quickly now towards electric. That will be a significant dent in transportation, which is an important part, of course, of oil demand, not the all important part, but an important part, and therefore, it's oil demand is going to roll over rather quickly. If you dive into this, it's actually quite unlikely. On electric vehicles, yes, we think it's absolutely likely that a couple of years from now, 25-30% of the new car sales will be electric. But fleets are about 10 to 12 years old. That means until you have, the full effect on the overall fleet, this is 8 to 10 years out. So basically, we have a situation where we think demand over the next 4 or 5 years the demand patterns will not look very dissimilar to what we've seen in the last 5 years. Cut out COVID as this huge but largely cyclical event. The oil demand discussion is a very tangible one later in this decade, early in the 2030s. But don't forget one thing: oil is a declining resource. So basically, we lose 4 to 5% of our production each year to natural decline. So it's in itself a run against the treadmill, and with investment levels at such low levels, we're setting the stage for a very difficult time period.
Okay, so would it be fair to say then, okay, you don't have no problem with the notion of energy transition? It's absolutely a real thing. It's going to happen. It is happening. It's just happening kind of slowly, and you're going to have growth in the demand for barrels, for the next 5 to 10 years.
I think in whatever way you look at it, I mean, this when you look at what people communicating on right now, I think we're very rich in zero emission targets in 2050 right now, be it companies, be it governments. But if we really think about what's gonna happen over the next 5 to 7 to 8 years, I mean, the substitution will be frustratingly slow, and that's disappointing. I say that. I talked about my renewables background. I believe in this stuff. It's going to happen. There's absolutely no doubt about it. But people will just be disappointed about the timeframes and also the real effect this has on stuff like CO2 emissions. Because let's not forget, that's the real thing we target, right? We're not targeting having an electric vehicle penetration of X. We're targeting CO2 emissions. And if you just as an example, just for the complexity, I mean, 40% of all EVs are in China. In China, coal still plays an overwhelming role in electricity production. So electrifying the Chinese fleet is a tricky proposition from a CO2 perspective. Germany, huge success in building out renewables. I fully support that. But if Germany went electric in transportation in today's energy mix or electricity production mix, the effects for CO2 are probably negative. So it only makes sense to also tie this into the new renewable the renewable growth in electricity production. Otherwise, you don't achieve what you want to achieve at the end of the day in terms of CO2 emissions. So the whole thing is very, very complex. Okay, so let's you're right, and it's maybe a little bit off-piste actually. Let's bring it back away from carbon and back onto oil. I mean, the other thing that that I think is quite striking, it's not like people aren't aware of this energy transition, and it's certainly not as if this energy transition is going to catch out, you know, the various kind of executives in the oil companies. You know, they're as aware of it. They read the newspapers. They're on the front line. They're kind of thinking about this, you know, every day. You know, which we all know about. What do they do? Like, presumably they're seeing what you're seeing. They can see that, listen, we get the whole green thing, but we're still going to need oil. But we've still got a future, but we might not have a, you know, 100-year future. How does that affect the kind of boardroom thinking? Well, it's George. One second, I'll leave it to you. I mean, they're in a super tough spot, right? And we see the big IOCs basically. I mean, it's just there's an imperative they feel from their shareholders and the public to basically map out a clear strategy into a carbon-free future, and it's a super difficult proposition. And you see the extremes of BP basically saying we want to have a 40% lower oil production in 2030. I mean, super tough for them because it's not that, you know, the offshore wind market or the utility market is underserved, right? They're having to go into business models that where we have players available. I think what they have to find out, and the whole industry, and we're having long discussions with our target companies as well, is that this whole sector makes a much better job in basically explaining to the world that they can play a real role over this next 5 to 8 years in controlling emissions as good as we can. In the way they produce the oil and gas, while this is only 15% of the carbon related to the whole value chain of oil and gas, this is something we can do about it. Something we can do about in really having progress here, where the usage, the end usage, is still going to be very difficult to tackle over the next 7-8 years, as I described.
Okay. There is more value added from BP cutting flaring today, as opposed to them promising to be a utility in 8 years and selling on their oil fields to someone who is not going to cut flaring. And I think this is something that really gets drowned out in the debate. I mean, if the oil company executives, especially in Europe, I think they are under siege on this topic because there is an element of greenwashing, in portfolio management these days. But also, I think when they are looking at their own project pipelines, they divide between what is known as short cycle projects, which are quick, which have a quick break even, which should pay back the investment on a, let's say, 18-month to 2-year horizon, of which shale qualifies because the time to drill a shale oil well is shorter, or in shallow water where the projects are not so complex compared to deep water, and also often have already developed infrastructure. And eventually then in terms of where a lot of capital has been invested in the previous cycle, which is deep water, they will only focus on the best and most prolific fields, which will serve to be as a baseline for production in the future, such as the fields we see in Brazil or offshore Guyana, because at the end of the day, that is where there is a lot of oil. And these fields are quite profitable and have great returns. The only problem with them is that they have a 30-year time horizon. And at this point in time, I think an oil executive can tell you, I'm comfortable with what happens in the next 5 years or maybe 10 years. Yes. But beyond that, I'm not so sure.
So this is okay. So this is actually a kind of a good link, because this I think is actually this is an important kind of point, right? That the logic of the situation would say that, you know, the high risk, long duration, long payoff stuff is, you know, very not so attractive, whereas the kind of short cycle, short duration, reasonably immediate payoffs just makes a lot more sense. It just makes a whole lot more sense, right? And you said shale and offshore. So I would have thought most people would have thought offshore was a bit riskier.
Well, the key advantage in this view of the world, or one key advantage of shale, is indeed the short cycle. That basically you have for good geology, you have a payback, perhaps 18 to 24 months, and that's one of the key attractions of this part of oil supply right now. The returns are not so great. They're also not as disastrous as some people think. The problem is just that these guys have run this as if they were a Silicon Valley startup, right? I mean, growing 20%, growing production 20% a year, and in a super capex heavy industry, which oil exploration is, oil exploration and production, doing this with a 20% volume growth target is just hugely cash consuming. And they're resetting this now. I think we're confident about it. So the big growth, there's a reset in production, 1.5-2 million barrels per day from shale, and from there on they will flatline and at some stage start growing again, but not 1 million barrels per day. I think those times are over. Now on the offshore side, and perhaps we can talk a bit about the exact assets we're invested in. There is the greenfield deep water stuff, right? Where everyone 10 years ago thought, this has to save the world. Yeah. Where some of the projects are economically super interesting and from a break-even barrel price, very competitive to shale. But it's the problem George just described. You all do this over a 25, 30-year lifetime for the project, and you feel happy about the first 10 years, but your equity value crucially depends on what happens in those outer years. But that's not the whole of offshore. A lot of stuff is happening in shallow water. The biggest jackup market is the Middle East, where basically those are very cheap barrels close to shore, existing infrastructure. This is no longer cycle than is shale. And that's very much where our focus sits. We believe in some select ultra deep water projects because we need a baseline still. But in doubt, we prefer shorter cycle exposure, and in our view of the world, this is more the shallow water side. Okay, so could you just, for the benefit of the people plugged in here, who might not be as familiar, could you just kind of give the archetypal kind of characteristics of these shallow water projects? What kind of features? And secondly, and relatedly, why are you guys focused on that and not shale, which I think would have been the kind of obvious kind of very quick turnaround, low risk barrels? I think you're on. Yeah. So the situation, what got us interested in this part of the industry was an industrial angle I had from the offshore side and understanding a bit how the marine sort of value chain works, and then also the carnage that was already obvious 3 years ago, where you felt like, okay, this has been massively overbuilt. You take a look at these fleets and think, okay, a good portion of that has to go. What am I paying for these fleets if I know, let's say, 20%, a third of the fleet has to go? And is this in what I consider normalized world an attractive investment proposition going forward? And that was clearly the case in 18, 19, sort of already. Now, shale is sort of a tricky beast. The strategy of these companies was just horrible, and it needs a bit different skill set as well, because you have to understand the geology a bit in terms of understanding, okay, what is really good rock and what is perhaps not so good rock, and that's not where I necessarily see our expertise. George, perhaps you talk a bit about the underlying assets we really focus on.
Yeah. I think also, just to add to Steffen also, what we're looking at are fungible assets, which, if you would bring them up on the screen, which make them a bit easier to value. So here, pictures are always a bit easier to use than words sometimes. So if you follow me from the top left, this is a jackup rig which drills in shallow water, what we consider to be, let's say, the shorter cycle part of the offshore industry. And where they drill basically is characterized by areas which generally have existing infrastructure. So you might be able to drill a well not too far from an existing producing well, tie it back to a pipeline which already goes to an onshore production facility which processes the oil and then puts it in a tanker. So this is really what distinguishes, let's say, the shallow water vis-a-vis the deep water, and that the infrastructure is easier and it's already there, it's already in place. And then since you have, the fields are older, the jackups actually do a lot of repair work and a lot of maintenance work on existing wells to keep them running. Then if we look at picture 2 and picture 3, which is basically a drill ship, the state-of-the-art asset of the previous cycle, and a semi-submersible, these constitute what is called floaters, which tend to drill in deeper waters. And this is where the big elephant fields have been found in the last 15 or even 20 years. These are very expensive assets. A drill ship costs around 600 million to build, and then another 100 million to mobilize and equip. And
600 million?
Yes. Yes, it's not a cheap piece of equipment, and a lot of these drill ships and semi-submersibles were built, financed with a lot of debt, and they came onto market in 2014 and 15 and 16, and some of them did not have any work booked either, which really is not very good, because you might be able to not pay any operating cost on an asset like this, but you still have to pay your interest bill. So these assets actually drill in waters which are more like virgin waters. So there is less infrastructure. So it's not enough to just drill an oil well. You need also to develop all the surrounding infrastructure in order to be able to take this oil from the ground or the gas from the ground and deliver it to market. So this is why the, let's say, floater market, generally speaking, is exposed somewhat to the longer cycle barrels, where we think there is some uncertainty. And then the fourth picture, it's of a PSV, which means platform supply vessel, which is a subcategory of offshore supply vessels, which basically play the logistic role in the industry. So a PSV is a boat which has like this open deck where you can put a lot of the supplies that you are taking onto the rigs, be it a drill ship or a jackup or a floater. They take crew, drilling mud, chemical. So basically a lorry, let's call it, that goes back and forth between the rigs and fixed production platforms, and supports the production process. So we really like these assets as well, because they are exposed. They have a baseline of demand, because there's always going to be production platforms there, but also because they are exposed to both shallow water and deep water, and they tend to operate globally.
So I think, okay, so that's kind of interesting. Suppose your kind of thesis is right, you know, you're kind of, the near term is actually, you know, pretty kind of rosy for oil and for oil demand. And they do need to kind of get this stuff out the ground, and they do need to do that in the lowest risk way possible, which is gives them a strong bias towards the shallow waters. Surely there's just plenty of those things lying around now, you know, kind of idled and you know, ready to, you know, presumably there's a glut of those kind of that type of equipment. So what I mean, yes or no?
Well, it's quite disastrous in some asset categories, and a couple of different dynamics come into play here. So there's been, let's summarize it, each sector has been overbuilt, and that's just a function of what was happening to 14. So we can safely say the overbuilding took place in each asset categories, but some are worse than others. Floaters, so drill ships, semi-submersibles, deep water. I mean, this is where all the new barrels were supposed to come from. So this is a very young fleet, as George mentioned, 600-700 million to build. Some of them have worked only 6 months or a year or whatever, and there's still all the debt, you know, has been around in these balance sheets, and there's the most carnage, and it's also the biggest exposure to the IOCs, the international oil companies, because they are the dominant players in that space. The jackup market, shallow water market, as I mentioned, the biggest, for example, is the Middle East. This is much more driven by national oil companies. And I mean, I don't want to go too much into politics, but one thing we'll see here is that a lot more percentage-wise of oil supply is going to be in the hands 5 years from now of national oil companies than we're used to. And these are the guys who have been sort of investing more through the cycle. They're also committed to the resource, as opposed to many of the IOCs, where we're basically changing their business models. So that's basically a lot of cross currents at play here. So our emphasis on shorter cycle and on the client space, sort of the NOCs being more active, leads us to for example, the jackup market. And the offshore service vessel market has its own dynamics. Again, there's some horrible categories. We're more focused towards larger platform supply vessels, some large anchor handlers as well. So where basically there's also an oversupply, but it's actually towards the end of 19, we almost reached something like an equilibrium. And the next slight increase in demand would have really got a pricing move going. Well, COVID cut this short, but we will be back to this level somewhere early next year. And so it's in this bigger trends we're seeing, we're trying to find those assets that we like the most. That being said, I mean, if we have a hybrid fleet of jackups and floaters, and we feel after scrapping a sufficient amount of floaters, this overall fleet is at a compelling valuation, then we'll go for it.
So what kind of economics are you looking at on for kind of unencumbered by debt, or what kind of economics are you looking at for some of these kind of jackups or service vessels?
I think one of the things that protected us sort of strategically in how we approached these assets was sort of the pure financial logic we would bring to the table. Don't forget, all these shipping guys, or also the rig brokers or whatever, they always say, okay, this costs 600 million to build, so we do a straight line depreciation, and then what this should be worth, and then okay. We from the beginning, because we knew the 13, 14 heydays would never come back in terms of day rates, we always thought, okay, so where might day rates be in 3-4 years time? And then it's a pretty straightforward DCF you can run per asset. The operating costs of these vessels are pretty well documented, so you can good amount of data to figure this out. And so in general, our view of the asset values, funny enough, hasn't changed a lot over the last 18 months. I think what has changed is that we think there's a slightly lower rig count in general going forward. So the world is still a different place. But the key thing and the carnage in this industry is really on the background of the fact that these guys build dozens of these hugely expensive assets and finance them with 80% debt. And now a lot of this has to head for the scrapyard. And if you have all this debt still on your balance sheet, I mean, it's just not going to work out. And this is why we've seen these broad-based restructuring, for example, in the drilling space, because it became clear to everyone that this is a completely unsustainable debt load. And most importantly, also with this debt load still in place, the scrapping, i.e. getting rid of the assets, couldn't happen, because you always had to tell your creditors, guys, this idle rig here is actually not a liability. No, it's valuable collateral against your debt.
Yeah.
And this is the key thing. While it's been a tough year. I mean, it was no hyperbole calling this whole thing a near-death experience. But the key thing, this is accelerated with COVID now, is that people threw the towel. Everyone understood, especially on the creditor side, that this is not going to work out. We have to do something, and the only way forward is broad-based conversion into equity.
Okay, well, listen, that's probably a good place to kind of pause. We've got a few questions, and in fact, I'll ask one of them right now from Andrew Wynn. We'll leave the other ones to the end, but Andrew is basically saying, okay, so what the high level thing is interesting. What are you guys actually doing about it? And Andrew says, within the Yacoub space, how are you translating your market perspective into positions in the fund? Do you own equities, fixed income, hybrids, etc.? And what kind of expected return are you looking at on these assets right now?
Okay, so what we decided to do is basically be capital structure agnostic. In a way, we do both equity and credit, but the way we approach it is the following way. On the equity side, and this was long before COVID, we felt like, you know, the normalized earnings will be way lower than in 14, but higher than they were in 17, 18. So we said we feel we have a decent idea where this is going to play out in the end, but it's super difficult to say how long this takes. And as an equity holder, I never want to be in a position where basically in a cyclical business, my recovery has to happen by date X, otherwise I'm in deep trouble. So on the equity side, it was a lot of actually some names that had gone through a restructuring and fully equitized their debt portion. Tidewater is a good example there, and basically saying, you know what, whatever happens, and if the cycle takes longer to play out, those are the last men standing, and we'll be fine. On the debt side, the approach was slightly different. There we were saying, okay, if we can create a fleet, an asset in a very cheap way through the credit side, then we're getting interested. So if you want, a restructuring angle was always part of our thesis. So to be entirely honest, we wouldn't have expected to have to recapitalize a lot of firms, you know, in the circumstances we did. But there's always a way in which you can use this to your advantage as well. But you know, the fact that we have to had to restructure a lot of our credit holdings wasn't a surprise as such. That was always an angle in the way we approached it. And that's what's been happening. A couple of the names we're involved in.
Would that be the two broad kind of buckets though? Like would basically, you know, kind of on the equity side, really robust balance sheets, last man standing, high ground kind of guys, right? You don't need to be completely right in your timing. On the credit side, you're quite actually, you know, willing to get involved with the restructuring. Would that be the two broad buckets?
Absolutely. And on the restructuring side, I mean, once we got into deep trouble last year, so take a name like Valaris, largest drilling company in the world, hybrid fleet, i.e. both jackups and floaters. And we had credit exposure to the name, thought a restructuring might be in play, but it was one of the scenarios. Then something like 2020 COVID happens. It becomes very clear, okay, this has to be restructured very quickly. And then the idea basically is, okay, it needs A, new money. It needs B, substantial amounts of debt to be converted. And how do we play this? And because there's a bit of a trade-off, right? I mean, we wanted to participate in the new money because we knew this would be hugely attractive, and I come to that in a second. But on the other hand, we have an existing bond position. You know, if the new money takes a lot of the value in the reorg company, it has to come from somewhere. So you hit your legacy position to a certain extent by advocating a highly attractive recapitalization economics. But this was a golden rule, if you want, in our restructurings. We basically said, you know, these holdings are in deep trouble. If we invest further amounts of money, we do this on the basis that the new investment is highly attractive, and we do not focus on necessarily this is where the recovery value and the upside is going to come from, not trying to on paper save a slightly higher recovery for your existing bond exposure.
Yeah, but what I mean, and you may be coming to it, but you know, the question was kind of quite specific. I think people would be very, you know, keen to know what kind of expected returns, you know, within the kind of range. What, you know, give people a kind of feel for some of the valuations that you're seeing.
So basically, we expect on a restructuring situation like Valaris, we expect a 3 to 5x on the money we invest, and I try to explain this with a couple of broad numbers. This company had total assets at the end of 19, Valaris, that is, of about 16, 17 million US dollars. So if you're on the book value of the assets, we didn't believe in this, but it's still, let's use it as a first yardstick.
Yeah.
Now we recapitalized this company, including a 500 million capital injection at a valuation of around 1.7 billion. So roughly 10% of the asset value before COVID started. Well, the accounting asset value, I would say. Yeah. We think probably that at the time the assets were worth, when the book said 19 billion, we probably had a 6 billion fleet valuation, and we do this really bottom up. We go asset by asset. Right. Probably right now we'd say 4.5 billion fair value of the either of the fleet, an NAV logic or an earnings multiple, normalized earnings multiple valuation. And as I said, we buy into it at 1.7 billion right now. So this is where the 3 to 4 is coming from.
So that's kind of basically just, you know, putting a kind of standard multiple on a kind of EBITDA of about half the peak or something?
In Valaris' case, it's more quarter of the peak. So the combined Valaris is the result of a couple of mergers in this industry, and consolidation is another important part here. So the legacy companies of Valaris had roughly 4 billion in EBITDA in 2014. Yeah. So we think this is more like a 700 to 800 million normalized EBITDA company going forward, and then that's how we.
Okay, so that, I mean,
sorry to interrupt. But super important in all of this equation is that we are saying we see 3 to 4 times X on what is essentially an unlevered capital structure. So we are talking about a company with no debt, no net debt. Yeah. So it's not like we are buying an option. It's not like we are buying someone which is highly levered. This is a situation where the company is unlevered. So from a downside perspective, one has to also remember how much protection there is.
And that would be would that be a typical kind of expectation across your restructuring bucket?
Yes. And we have a similar deal with Diamond Offshore, and the economics are somewhat similar. I mean, each and every fleet has its special bits and pieces, but I mean, it's obvious also because almost all offshore drillers went into Chapter 11. The deal structures and the underlying valuations have been quite uniform. Where we see a deal now, we know the financial advisor, we know how this is going to play out across different bits and pieces. It's been a small club that has established itself there on, I mean, the general investor left this space a long time ago, and there's simply no real sell side coverage on these names anymore, whatever. There's a bunch of distressed guys. Also a big turnover on these names. A lot of guys we did deals with in 17, 18, you know, they're long gone, and we're happy to be around, to be honest. Yeah. But it's a specialized thing. But let's not forget, I mean, these were 15, 20 billion market cap companies 6-7 years ago. They're not going there, don't get me wrong. But you know, they will be picked up again once they're fully recapitalized. We're talking Valaris, a 1.5 billion market cap. So there's definitely an angle to that as well.
I mean, that's one of the really striking things about the space. It was a big sector, and it's basically gone to zero. I mean, in terms of equity values, it's basically gone to zero. And then you're looking at some of these kind of, you know, they're trying to restructure, and they're kind of restructuring it like 10% a book. You know, and I mean, it is kind of, and there's just no one around. And I've kind of spoken to a few people about it, and they've just said it's just not worth it. It's too small. They've gone from being kind of, you know, mid to large caps to being almost micro caps.
No, I totally agree. But let's not forget, I mean, just because something has fallen so much does not necessarily mean it's attractive. But there's a vital function these guys still perform, and it will be a smaller industry. We even think, and to a certain extent hope, this will be an industry somewhat in runoff, right? Because the last thing we want is these guys, whenever they make money again, going back to the shipyards and order new equipment. But that's not what we think and anyone think is going to happen. So the moment the cash flows are coming in, which will be in about 2 years' time in our view, then the job will be, but I'm not too nervous about that, also making sure that this becomes basically distributable cash to shareholders. The reinvestment thesis for this business is pretty much broken. So the cash is there to be distributed.
Well, that's, you know, that will be a nice problem to have when you have it. Listen, just going back, you said kind of 3 to 4x on the restructuring book. What about the kind of equity plays, you know, the kind of last man standing type ideas? What kind of returns are you expecting there?
Yeah, it's a super interesting one because Tidewater is our biggest position, and it's basically the restructuring that happened in 17, but one of the very few restructurings that ticked our box because they really converted all the debt. And it didn't protect us, unfortunately, from a mark-to-market perspective, this last man standing kind of thesis. But the returns are very similar. I mean, up until 3 months ago, we even had an 8-9 times on Tidewater. It has moved substantially since then, but the 3 to 4 times is still very much in order, and it's again an unlevered situation. Peak earnings, if you adjust Tidewater as the result of a merger between the legacy Tidewater and Gulfmark, they had around 600 million peak earnings combined in 15. I think it's fair to actually adjust the synergies that were taken out of the combined entity, because this is very easy being done. This is why we press so much on consolidation in the sector, because they have all a very similar footprint. So the moment you combine these entities, there's a lot of costs that can immediately be taken out in terms of not just the headquarters, but also their shore-based operations in all the major regions. So there's another 50-60 million in SG&A they took out. So the baseline is probably more around 630-640 million EBITDA in 14. Our bottom-up idea of EBITDA is in the 250 to 300 million area for Tidewater, sort of normalized. Company enterprise value is around 650 right now, so we're trading 1 times previous peak earnings. We think it's probably more like 2 times normalized, but I still think that is, historically they were around 6-7. We can have long discussions, you know, around the multiples going forward. Time will tell. But with what we expect to happen with cash flows, because the reinvestment thesis, ordering new equipment, is just not there. I mean, right. Once the cash is there, then we can have a discussion. You know, the free cash flow yields will be quite staggering, and we're not as dependent on an EBITDA multiple discussion in our view.
That's
for the companies in the space which have a full order book, and they do exist, 1 or 2. We are talking about free cash flow yields of around 20 to 25% of market cap.
Yeah, interesting. How many stocks are in the portfolio? How many positions have you got?
So we got, George, help me out, 5. We're very concentrated book. That's what we are, and we have a very close engagement with these companies. We know the managements. We've been in the restructurings. We always try to play as good. I mean, a small fund, right? But there are not that many dedicated guys around the table. So you deal with a lot of generalists that sometimes are quite happy to talk with sort of specialists also in these committees, and that's been that allowed us a seat at the table. Let's put it like that. Not the dollar amount we were bringing to the table. So we have 1 to 5 equity positions. Exactly, and in one situation where we're actually both in the equity and the credit position. So as I said, we're approaching also the credit side with an ownership mindset, because very often it just is a restructuring logic behind it. So we assume to be the owners of the business at some stage. But yeah, we want to be concentrated. We want to know what the companies we're dealing with. We want to know the management teams, and also be able to here and there really influence a bit where things are heading.
And I guess, I mean, and I'm mindful of the time here, but it's kind of what you guys are doing. I suppose it's not quite the same as, you know, an ordinary kind of equity manager. right? You know, we get an old equity manager, you know, maybe they've got a portfolio. A concentrated book would be 10 stocks, you know, a less concentrated one would be 50. And there's going to be a turnover in the book because, you know, there's competition in each of their sectors, and there's new entrants, and there's exits, and there's changes in strategies. That's not really, it's basically kind of one thing that you're doing. It's not, it's quite a kind of different approach, isn't it?
Yeah, and it's also an important point to mention that, you know, these are not inherently great businesses, right? I mean, in these asset-heavy businesses, it all depends on trying to enter this at what you hope to be the low point in the cycle. We got upended on that one, most definitely. But it's super important to also make sure, you know, that in the normalization you slowly fade out of it, because it's right. Just this is not the big compounders you hold in your portfolio where you just ask yourself, you know, I got the buying decision, I need to get this right once, and then I want to own this. This is not the kind of industry. We just think it's an incredibly interesting setup, and COVID has accelerated now so many things. But we think there's a 2 to 3 year time horizons to own these assets, to realize sort of these 2 to 3 to 4 times invested capital. But then, as we always say, don't forget the selling, because this is not sort of buy and hold for a 10-year time period.
The idea behind this fund at the end of the day is to go very narrow, because we feel that this is where we can add a lot of value to investors. Once we develop this theme and meet the returns that we promise, hopefully, then we would either return the money or come with a new theme. Right. Because I think the general equity type of portfolio manager, which has 50 position or 60 position, is already quite well covered by large investors.
Yeah, absolutely. Okay, listen, last question before we wrap up. Someone was asking, and it's a little bit off piece, so I've been saving it for the end, and I'm not sure it's necessarily your expertise, but I'm going to ask it anyway. One of the viewers was wondering if you had any thoughts on the implications for refining assets, and especially legacy refining assets. He said China and the Middle East have built significant refining capacity.
I mean, we're following the space more on the peripheral, so not really claiming to be an expert here. I mean, there's also a lot of stuff sort of going on with different fuel compositions and the impact potentially on biofuels and all that, but not really qualified to make a educated statement on that front. I'm sorry. Okay, no problem. Honesty is the best policy. Well, listen, thank you very much indeed, guys, Steffen and George. Really enjoyed that, and everyone for who joined us this afternoon. Thank you too. We know the time is short. We're all pushed, so it's enormously appreciated. So from all of us here, from all of us at Altana, thanks very much. And you know, final thing. Do reach out to the guys, do reach out to any of us, but if you do have any questions or you want to know more, do reach out to Steffen and George directly. Okay, thank you very much. Excellent, Dylan. Thanks so much.
Thank you. Thanks.
Bye, everyone.
Bye.